TheoTrade. This is Don Kaufman. It's September 6, 2019, and you are watching the TheoTrade Weekend Update. All right, second week in a row, rip and rally to the upside, and we actually broke outside of the volatility box, again, specifically to the upside. But then you really do have to ask the question, based on a lot of factors that are occurring in the marketplace in just the last 48 hours of trade, listen, how sketchy is this rally? That's something we're going to be looking at quite in depth on this weekend's update, because there's all kinds of risk assets, which again, we're going to look in detail here when we get to the charts in a moment, that are saying otherwise. So a few things we want to mention before we get down into it, before we look at a couple of trade opportunities, a few charts. Number one, the SPX expected move has been absolutely spot on, precision, if you will. For those of you that don't necessarily tune in on a day-to-day basis or even a week-to-week basis, we talk extensively about the SPX, which is an options-only product. We look at the options, for example, on a day like today. This is a Friday afternoon. The market has just closed, and we will look at the options market to discern, okay, how the market is pricing risk into this next week of trade. And again, in this example, if you will, the options marketplace for a week from now, Friday. So I'm looking again at Friday's expiration, exactly 7 days from now. It is giving us approximately, okay, a $37 move, meaning the options market saying like, hey, we're supposed to move $37 either higher or lower. That number, that expected move, has been, again, precision in the previous 2 weeks. Okay, the example happens to effectively be, if you tuned in for, this past Wednesday night's video, I was talking about how the marketplace had pretty much done nothing, on Tuesday, a little bit more nothing on Wednesday. Sure, we sold off a little bit here, we rallied a little bit there, but we had still a massive amount of room to move inside of this past week's expected move. And the reality is, on Thursday, we got every ounce of that move effectively played out, and we got every ounce of a $60 move to the upside. Again, it has been absolutely spot on. Wait for a moment, because I'm going to show you here in much more detail in the charts. There are so many trade opportunities, people, surrounding the idea of expected move. It's not, please, it's not just about like a butterfly here, a butterfly there. You could be scalping futures. You can scalp Nasdaq against this. You're going to look at the XLF here in a minute. You're going to look at the Nasdaq. It is shocking how efficient this marketplace has become. And there's actually a great argument to be made this week that the breakout to the upside in the S&Ps isn't so much like buying, but it has everything to do with what we term dealer gamma risk, which is effectively it's market making firms that are out there buying and selling options, and the hedging activity. The hedging activity actually drove us not only outside of the volatility box, but drove us up in the last 2 weeks. And again, I'll show you here specifically why we believe that is what is occurring. One other aspect I'd like to get to before we jump into some of the charts and some of the trade opportunities, you have to talk about the Fed. First of all, the Fed. Okay, Jerome Powell happened to speak today. The important point of Powell's speech today, JP hit the main stage. What did he say? Yada, yada, yada. Absolutely nothing. We'll see you on September 18th. Listen, the Fed's going into their quiet period right now. That means that was it. That's the last that we are going to hear from Jerome Powell or anybody in the Fed until September 18th. Why is that interesting? Because the Fed fund futures, if you look at them in terms of probability, they're still assigning a 91% probability, okay, of a quarter point cut on September 18th. However, okay, he hasn't really changed, and Jerome Powell hasn't really changed a lot of that rhetoric. He's like, this China thing is kind of slowing us down. Again, they didn't say that much today. Hence why the market did pretty much squat in today's trading session. Nevertheless, okay, there's still a 91% chance of a cut. However, at the last FOMC meeting, let us not forget that the Fed dictated to us that this was nothing more than a mid-cycle adjustment. No other cuts, were being viewed in the near future. It was very data dependent. So I got to tell you, we are left hanging here. Then we're back to this phase of bad news might actually be good news for the marketplace. The jobs number came out today. It missed, not by a tremendous amount, but it missed 130,000 jobs, and the market loved it. Why? Because it's going to increase the odds of the Fed actually moving forward on another rate cut. People, we're hooked on the juice. We're hooked on the low interest rates. But again, I want to show you a couple of really interesting aspects regarding this kind of breakout to the upside in the SPX, because it really points to quite a sketchy rally. With that, let's get into it. You're gonna find some of the charts, some of the trades quite entertaining over here. Stay tuned. Continuing on our theme in this weekend's update, well, let's answer the question, how sketchy really is this rally? What we're actually going to start with is a larger belief that I specifically have, is that gamma really broke the markets substantially higher. And I'm going to use quite a bit of evidence to effectively show that here momentarily. When I talk about like gamma, though, breaking the markets higher, all right, first and foremost, let's go over to the S&P futures, and you kind of zoom in on the S&P futures. When I was talking about this volatility kind of channel, or sometimes we refer to it as the hurt locker, the volatility box, you name it, we've called it. Listen, we've cracked outside of it. But when I say, like, this rally really kind of seems a little bit sketchy, what am I even pointing to? Well, there's a few factors that just stand out here in the S&Ps. And one of the factors happens to be that there's just a lack of volume, if you will, on that kind of breakout. So you could say like a lack of conviction, if you will. Listen, yeah, the volume spiked. If you take a look, this is just day-to-day, trade here. Yeah, the volume spiked a little bit, maybe 1.6 million contracts traded, and that was on this big breakout, if you will, to the upside out of the volatility box. So I'm a little bit bothered by that, because it looks like this wasn't a lot of buy-side activity in the marketplace. More or less what it came down to is just hedging activity. Now, what would further that? What would further that is, let's not look at just the S&P futures. First of all, a lot of you guys, like, you're not necessarily S&P futures centric. Maybe you're more into something like, I don't know, Apple. Okay. If this is breaking outside the volatility box, all right, listen, a ton of the stocks on my screen right now, this is like the marquee stuff. They should all show, kind of big volume breakouts, which they don't. There's Apple breaking outside the volatility box. Listen, Apple was also caught between a rock and a hard place for a long time. It breaks to the upside, you got nothing. Microsoft didn't actually break really to the upside very much, but Microsoft kind of exemplifies this volatility box. Here's the break to the upside. What do we got? It almost did some decent volume? No, not really. I mean, we can go on and on and on all day long here. You can start looking at individual products, on pretty much until you're blue in the face. You're just not going to see this big bump up in volume. And I'm also going to point that out here momentarily. We get a little further down when we talk about bonds and risk assets. So when I talk about gamma breaking the markets higher, a lot of people, they don't really get, again, what that kind of means. It means this, and I'm just going to zoom in here to the S&Ps for just a second, and I do want to spend some time on this because, listen, this is what's driving the marketplace like the last 2 weeks. So here's a move, from last week. This is where we started, again, in the previous week, and we drove right to the edge of the expected move, right? This is this week. Now, we only had a 4-day week, as I said. On Tuesday, a little bit of nothing, followed by what? Wednesday, a little bit of nothing. And on Wednesday night, I said, get ready. We're going to move, and we're going to move big. We're going to move to the edge of one of these expected moves. Nevertheless, we moved basically up, hit literally the edge of the expected move, and then rode there, for the remainder of today's trading session. So why are we being driven to the edge of the expected move? Because there's not a whole lot of oomph behind this marketplace, What you're getting, day to day, yeah, this was news that started okay, this little bit of a rally to the upside. What was the news? It was China. I mean, come on, though. We're just setting up a meeting with China. It had nothing to do with like trade war. The trade war is still on right now, but we're setting up a meeting with China. And what happened is the S&P futures started to jump higher. And as the S&P futures start to jump higher, okay, those that are what we term short gamma, or even more importantly, short delta, if they're short delta, what does that mean? Okay, it just means that they're caught short the markets. And as the market starts to go up, if you're short the markets, you get killed. So what the dealers do, dealers, market makers, is they add long delta. Okay, they add long delta in there. So they're adding long delta, okay, to the equation, and effectively it's driving the market higher. But the higher the market goes, okay, the more short they get, the more long delta they have to add. All right. And then we hit literally right to the edge of the expected move. Why do we stop there? Because we stop there because that's where basically the longs and the shorts effectively meet. That's the edge of what we term a straddle. Now that's where things get a little dicey, probably a little too deep to go into on a weekend update. But again, it describes almost every single move that we've seen as of late. Now, with that kind of in mind, again, we believe that gamma really broke this market's higher. Not necessarily like there's not a lot of people out there that are like, oh yeah, I got to go out and I got to buy me some Netflix right now. I mean, obviously Netflix is kind of waning. I got to get me some of that Facebook there, which ironically closed down on the day. But look, like Facebook, not really exactly breakout volume over here. I got to go get me some Amazon. No, there's not really any Amazon. Okay, the big stocks that have been leading the marketplace were not really participating, at least from a volume standpoint, in this rally. This rally was all about, okay, being caught short gamma, short delta, and hedging. Okay, and if you don't believe it in the SPX, go take a look at the XLF. Now, the XLF happens to be the financials. Watch this. So I'm going to turn on the auto expected move. You know what auto expected moves is? Okay, it just basically draws an expected move for you. And look where we ended up. All right. So if I zoom in tightly to this expected move, and I'm going to do just that, the expected move, that line was on 27.44. Okay. Where do we actually end up on the day? 27.44. I mean, we literally landed on the expected move. You're like, all right. So the SPX, all right, is a what? Okay. It's roughly speaking, that's kind of hard to look at. The SPX is roughly speaking a $3,000 product. $3,000 product. Now, I'm literally going to take this all the way down, if you will, to intraday trade. A $3,000 product literally stopped cold in its tracks because some guy in Scottsdale, Arizona, draw a line across his screen. No, because there's tens of billions of dollars at risk on the edge of these expected moves. And that's what I wanted to show you. By the way, not just the SPX, not just the XLF, but you also have to throw in there the Qs. Okay. The QQQ, if you bring up the auto expected moves there, I mean, this is, again, the Qs closed at 191.59, and the edge of their expected move is roughly 191.22. We're within, again, 30-40 cents of the edge of the expected move in the Qs. Crazy how efficient, again, markets have effectively become. So it makes you look at this rally very, very differently. That the rally isn't so much like, oh, I need to buy something. It's not about buy side activity. That rally, okay, is effectively just hedging activity, which leaves us in quite a precarious place. Which brings me to my next point. The market volatility, is it dead? Is it gone? Okay, is volatility about to take another dirt nap? Let's start with the volatility futures. For those of you, if you've never looked at a volatility future, welcome to the volatility futures. Welcome to Thunderdome. I'll zoom out for a second. First of all, when you look at the vol futures, you kind of want to look at like 40-day risk. Then we go to 75-day risk. Okay, and then all the way out to like 103-day risk. All I want to show you, follow along over here. Okay, risk 40 days out is at 1762. Then risk 75 days out, it jumps mildly to, let's just call it 18. So there's very little differential between the 40-day and 75-day, okay? But then between the 75-day and the 103-day, it actually flips over into what is termed a backwardation. You're like, I don't get it. All right, let's go to the charts and go over to product depth. How about I chart it for you? That always helps. So volatility kind of goes like this, and then it backs down. What it's saying is, right here, right now, there's not as much risk as there is a little bit further out in time, okay? But there's more risk here than out here. Let me just tell you, this doesn't leave you with a warm, fuzzy feeling. If you understand a little bit more about volatility, okay, we still have a degree of backwardation in there, which kind of puts you on the edge of your seat. Then you look at the VIX, because everybody loves to talk about the VIX, so let's cruise over to the VIX. Yes, the VIX has come down, okay? The VIX has come down, but let's not forget that we're a stone's throw off the all-time high in the marketplace, and we still are sitting at a 15 VIX. The VIX has come down, but it's not getting just downright crushed. Don't get me wrong. If these S&Ps rally a few more days, this VIX may get downright crushed, but hold that thought for a second. Then we go to the bottom of the screen and we look at the VVIX. Now the VVIX, here's one that just doesn't give me, again, kind of a warm, fuzzy feeling. That's what I'm getting to, is that, yeah, we just saw this big breakout rally, but I don't have the big, warm, fuzzy feeling like, oh, this thing is going to last, because these risk assets they're just not showing it. I mean, the VVIX, the volatility index, still at 95. You know, it just says like the market right now, yeah, it's kind of teetering a little bit higher, but apparently the professionals, they're just not buying into the idea that we're exploding to the upside. Now, let's further this with bonds and risk assets. All right, so bonds, okay, hey, any day would not be complete without mentioning bonds, okay? Do the bonds look like the S&Ps just broke out to the upside? Yeah? I have to ask the question because I don't really see any downward momentum in these bonds. Now, okay, I'm not saying that can't happen, because I'm going to show you a trade for that here in just a second. All right. But it's not just about bonds. It's not just about notes. You can pull up notes too. All right. So the notes had a rough day yesterday, but they finished massively unchanged today. And then we start looking at other risk assets. Okay. This is what I would call stuff. Let's label this stuff that should go down big if the markets are going up. Stuff that should go down big. What I'm talking about, like risk assets, I hate these terms. Wall Street, what has it done to me over the years? This is, shall we call it, short me if you love the idea of the rally. What I'm basically saying, like XLU and Walmart and Mickey D's and XLP and IYR, which is real estate and gold. People, okay, if the S&Ps are breaking to the upside, shouldn't this thing get crushed? Look, it's maybe starting here, but that's pretty negligible. It's more or less just backing off. That's why I'm just not biting on this thing just yet, biting on the idea of the rally. Then I looked over at like Walmart. Oh, but still my heart. It may have had a key reversal yesterday and down negligibly today. Then you look at something like Target. I just had to throw Target in here. By the way, if you're unaware of this, pull up Walmart for a second. Year-to-date percentage. It's up 23% year-to-date. Did you know that Walmart is outperforming Amazon on a year-to-date basis? Oh, yeah, that's a safe marketplace. Then you look at Target. That's okay because Target's outperforming all of them. Right? Target's up some like 60 some odd percent. There you go, 65% on a year-to-date basis. And then you start looking up stuff like McDonald's. Again, why am I bringing up McDonald's? Because it's up 25% and it's McDonald's. And yeah, it pays a 2.1% dividend, but it's not fading at all. And you consider these like, you know, I can go XLP and I'll go IYR, okay, which is like real estate. This thing is not backing off at all. This has been used as a defensive sector, okay? And then I'll kind of wrap this with gold. Okay, gold. Okay, gold came off. Not that much. So we are left in a big catch-22. The marketplace right now has seen the S&Ps break higher, right? We've seen the S&Ps break higher. But again, those risk assets and the bonds, they're just not backing off. That's why I say XLU and Walmart and McDonald's and XLP and IYR and gold. Short those products if you love the idea of this rally. I told you I was going to get into some kind of entertaining trade ideas, and those are just that. Now, the other one that I would say that you have to consider is something like TLT. I'm still involved heavily in back spreads in here. If you have no idea what those back spreads are, tune into any of the recent sessions, the recent morning sessions on TheoTrade. Take a look at some of those back spreads we did over here. Those back spreads, I mean, listen, if the market in the TLT craters, we're going to make a lot of money. But if the market stays flat, we're actually going to make a little bit of money because there's a credit for some of them. If the market explodes higher, we're going to make a little bit of money. And so I like the idea of the back spreads inside of the TLT. Now, let's move onward and upward. Let's go to the Fed, yada, yada, yada. See you on the 18th. The only thing I wanted to show you on this one that's still quite staggering. Happens to be, this is the probabilities, okay, from the CME Group site. It's basically, there we are on September 18th, and there's a 91% chance they're going to cut. There's nothing else to tell you. You could read all day and all night into what Jerome Powell said, and you're not going to be able to discern much of anything from that conversation other than it doesn't matter. The market says that he's cutting rates along with the Fed. That's it, okay? That's it. I mean, what are they going to do at this point? Okay? The market told you that you have to cut rates. What, are they not going to cut rates? Okay? Then it's going to be a Fed fumble, a frumble. I mean, what are we looking at over here in the next 2 weeks of trade? Is the marketplace going to have to prove to the Fed that you need to cut rates? I mean, it's a breakout rally. We're near all-time high, and yet they're cutting right now. Now, the last thing I want to finish with over here, all right, this one's big. The SPX, the mother of all products. And one of the things I haven't talked about yet, I was talking extensively about, hey, listen, these last 2 weeks have been just precision inside of the SPX, hitting the upside of the expected move, right? And in almost every single recent week, we've touched higher or lower one of the edges of the expected moves. This next week of trade, right here, I'm just going to draw this really quick. Notice anything unusual, okay? Well, what you should notice is last week, right here. By the way, this past week, this was a 4-day week. It had plus or minus a $60 move. You know what this week is? A $37 move. The volatility contracted quite considerably inside of the SPX. Let me actually show you specifically. Okay, you look out about a week, $37 and change is the expected move. Buy, baby, buy. Long gamma's got to be your friend. All I'm telling you, okay, is moving into this next week, no way, no shape, no form am I selling premium. Okay, quite the opposite. I'll be on the buy side of premium. You don't have to do it in the SPX. You can go over to the Spider. The Spiders is a softer, gentler place, a place you could do business without getting your head taken off. Okay, the expected move in there is negligible on a week where, hey, the thing I want to point out, if you look at the expected move in the SPX, all right, and again, it's what, $37 expected move. Do you realize when you start looking back at the S&Ps from just this last week of trade, again, forget all the lines and all the garbage that we draw on the charts and MACDs and Fibonacci's and Bollinger Bands. We don't need any of it, okay? All I want you to recognize. Now, you can look at the S&Ps in this. You could look at the Spiders. You could look at the SPX. All I want you to realize, okay, almost every recent day of trade has had like $30 moves. Well, maybe not so much today's trading session, but almost every recent day of trade has had like $30+ moves. And yet, the SPX is only pricing in, okay, a $37 move for the entire trading week. With that, I'm going to leave you with those thoughts on this weekend's update. Hey, according to me, this rally is quite sketchy. Have a wonderful weekend. Bye-bye.